Hello, my name is Michael Cowden. I'm a senior price reporter at Fastmarkets. I cover flat-rolled steel. Today I'm going to be talking about U.S. hot-rolled coil prices as they compare to HRC prices in Northern Europe and China. Our U.S. hot-rolled coil price and our Northern European hot-rolled coil price, they're both updated daily. So one thing that stands out from this chart is how high U.S. hot-rolled coil prices tend to fly above those in the rest of the world. That's partly as a result of hot-rolled coil here being broadly covered by traditional anti-dumping and countervailing duty orders. And you can see that Section 232 had the effect of taking this trend and really putting it on steroids. U.S. HRC prices shot above those in the rest of the world in 2018, and they really didn't come back down to earth until the trade action was removed against material from Canada and Mexico in 2019. Keep in mind, both countries and Canada in particular are important suppliers to the U.S. market, given how interlinked North American supply chains are. Another takeaway from this chart is that U.S. prices tend to bounce on top of European prices like a ball. So when European prices get too close to U.S. prices, mills here in the U.S. tend to announce price hikes. We certainly saw that happen in early May. The U.S.-Europe HRC spread compressed, and U.S. mills announced price increases of $50 to $60 per ton. I think it's worth keeping an eye on that spread again now, because U.S. and European prices are basically at parity. One reason for that is probably the toughening of EU safeguard measures, which went into effect on July 1st. So that has allowed EU mills, it seems, to raise prices. Keep in mind that integrated mills use iron ore and coke as their primary inputs, whereas ferrous scrap is the primary input for EAF producers. And that's important because EAF producers account for the bulk of steel output in the U.S., so that scrap price is really an important indicator. But I think what's really interesting to note is that the Chinese price is now the highest in the world. That's very, very unusual. In fact, it's possible that that hasn't happened in at least the last 7 years, or as far back as the status series goes in the dashboard. Chinese demand has been strong, and you can see that reflected in higher prices for global metallics, whether that be iron ore or semi-finished goods such as slabs. What's going on here? Is it because Asia has a better handle on COVID than the US? Are we seeing a paradigm shift of some sort? I'll leave those questions for an economist, an epidemiologist, or a political scientist. As for the U.S. steel industry, my takeaway would be that assuming the structure of global markets is not seeing some sort of seismic shift, I'm not ruling that out, I should add, there's no obvious reason for the U.S. price to move significantly lower, especially should prices in China and Europe continue to rise. Otherwise, the U.S. price would be the lowest in the world, and if something like that were to be sustained, I think we have to throw out the old playbook and get a new one. I'd be interested to hear your take on this, because it certainly appears that we are in uncharted territory.
Thank you for watching. To learn more, attend our upcoming webinar, U.S. Hot Rolled Coil, Sprint or Marathon to Recovery, on Wednesday, September 9th at 12 p.m. Eastern Standard Time.